Jake T. Davis here of Woodbridge Real Estate with
Jared Evenson here, and this is your Cougar Real
Cougar
Estate
Real Estate Podcast.
podcast. We just came up with that, man. That's good.
Yeah, so we're going to be talking about real estate, financing, Cougar sports.
Yeah. You know what we should talk about to get started though is that new Old Crimson Lager beer. I'm excited to try that out.
How do we get some of that old crimson?
I think we're gonna start seeing it on in bars and shelves around here pretty soon. But I heard it's pretty good, and I just read an article today saying that it's supposed to bring in like up to $20,000 a month in NIL money for WSU athletics, which is pretty sweet. We could use that.
Yeah, I'm kind of interested how that works out. Yeah, that seems pretty cool. Jared, you know that I'm a real estate agent. I also am interested in real estate investing.
Yeah.
So I thought today we would talk about real estate investing and financing.
Yeah.
I guess my first question of the day is: so if I am if I want to get into real estate investing, I own a home. How can I get started?
Gosh. So this is a big topic, and it's something that's come up a lot lately because um, people are wanting to find ways to diversify their portfolio, and they're finding that real estate is one of the best ways to do that. There's a lot of things that we can get into what you need to think about before doing that, but how can you get into it? So a lot of people are using, have you heard the term, you have heard the term house hacking though. So many people, the best way to get started in the real estate investing, one is to own a home already, right? Your current primary house, and either let's say you bought 4 years ago, 5 years ago, or more, and you've got some good equity in that house, using the equity in your existing house as a vehicle to help you buy the next house, whether that next house is a house you're going to move into and live in as your primary residence, and you'll be converting your existing house into a investment property, or staying in your current house using that equity and taking that money from that equity, kind of like a big ATM, to put as a down payment on your next house if you don't have anything else saved up, because that's the big thing, is down payment is most people's biggest obstacle, right? So
Okay, so let's say I own a home and I want to buy a $250,000 duplex in Pullman. Well, I don't
you're
know.
gonna have to time travel back to
All right,
1990.
let's say Colfax or
Yeah,
maybe
okay.
Endicott.
Yeah.
Uh, anyway, so a duplex. I don't have a whole lot of cash, but there's a really good deal on a duplex. How do I pull equity out to
Gosh.
use that for a down payment?
Yeah, that's great. So pulling equity, like I can do home equity loans, but what I tell most people to do is finding like that local credit union in town. I'm not going to name any of them here, but typically your credit unions are going to give you the best deals on like a home equity line of credit or a home equity loan. And the way those work is basically they'll take your existing house that you have and we'll find out how much equity you have in that house. So if you own a house for, let's just say your house is worth $500,000, you bought it, 3.5, 4 years ago for 400 grand, and today it's worth $500,000. And let's say maybe you owe $350,000 on the house, you've got $150,000 in equity sitting there, and you can tap into that and get a loan against that. That'll give you cash, and that cash you can use to then turn around and put it as a down payment onto another house. Now you're paying, a lot of people, they don't want to mess with their first mortgage right now if they got it in the 2020, 2021, either you bought your house during that time or you refinanced to a lower rate, but they're in, interest rates that starts with twos and threes. You don't have to get rid of that loan. You can keep that loan and add a second loan on top of it. And that second loan, yeah, it's going to have a higher rate, 6, 7, 8, 9%, depending on a whole bunch of different factors. But that's also, it's a smaller loan. It's a smaller chunk of money that you're just using to get a down payment to help put you into an investment property. And, figure, do the figure, run the figures, get the numbers. At the end of the day, for most people, it just comes down to payment. The interest rate's what it is, but if it makes sense for you to get this second mortgage to help you want a duplex, and the rents in that duplex are going to be enough to make you feel good about using this vehicle to get you into that house, then do it all day long. It's a great tool. It's how a lot of investors get into the investment market.
How much do I need for it? So if I'm not going to live in the duplex, how much do I need for the down payment? What's the percentage?
So you can get away with 20% down. I tell people you're gonna want to try to do 25% down. So it just makes such a huge impact on your payment, your interest rate. But on top of that, that's about where you start seeing the cash flow break even with the expenses. So your rents coming in, breaking even with, what your housing costs are there. So when it comes to investors, a lot of it cash flow, right? You own some investment properties, some rental properties, and there's two things to look at. You might not have a positive cash flow, like 100% positive cash flow. You're not going to go buy a house with the minimum down payment as an investment property and make money, positive money on it right away if you're doing, long-term rentals, but you're building equity, as you're doing this. And so it just depends on what your expectations are, your long-term goals for that investment property. Rents are going to eventually go up, right? Your equity is going to continue to grow. Interest rates on mortgages are going to go down. So we'll be refinancing to lower payments eventually, to where now those rents are going to positive cash flow. So, ideally, in a perfect world, you come up with 25%, but you can get away with a little bit less.
And if I'm going to move in to this duplex, one of the units, my down payment is less and I get better interest rates if I move in.
Better, yeah, everything's better all the way around. So that's the other way people do it too, is they will uh, depart their existing, and even if the duplex is your first home too, buying a duplex as a first house is a great way to get into, one, real estate ownership, owning a home, but two, investing as well. And we can talk about that a little bit. But if you're, departing another house, yeah, you do as little as 5% if you're going to live in it. So a lot easier when it's a primary
That
residence.
was my first property, was a duplex, and we rented out. So I bought my first duplex back in the day for I think it was 189 in Pullman, and
Yeah.
then we rented out the bottom unit, and then we also rented out one of the bedrooms in our unit, and so I was living for free. I was like making pretty much the whole payment, and I don't understand why more people don't do that. I explain it to them, and it seems like it's too much of a risk for people. But in my mind, right now, especially, I would think that's a good option for buyers. Are you seeing more people buying duplexes now than
They totally want to. Yeah. Do you still have that duplex?
I do?
Yes. There you go. Great investment. So people are, it's, especially when you're looking at home affordability, like, of course, everybody wants, white picket fence with a house on the, acre and a big, huge yard and yada, yada, yada. But what they don't realize is most people don't start with that house. They start with something like a duplex or a starter home, and they use that house. That's your vehicle to get you into your, closer to your dream home and whatnot, or your, you know, financial goals. And um, I'm seeing a lot of, with FHA loans, especially, you can buy a duplex with 3.5% down. And in some cases, you can even do that with down payment assistance too. So you get nothing. And that's exactly what it is. You might end up with a $2,000, $2,200, $2,400 payment on that duplex. But if the person on the other half is paying you $1,500 a month, now you're just paying $900 a month. And some folks, they will get a roommate that's going to pay them $600 for one of the rooms. Now you're paying, only $300, and you own the house. You're getting the equity and all those benefits there. And it's not used enough, because everybody wants to jump straight to the dream house. It's like, well, take steps to get there.
Yeah, I didn't. I don't know. I was more interested in buying rental properties. As I guess, like instead of buying a nice house, I was more interested in buying investment properties to start. So I'm always, I'm always like, why don't you buy a duplex? And I guess a lot of people don't think the way I do, but to me, it makes sense. You buy a duplex, you live on one side, rent out the other, have that for a couple of years, and then, and then maybe buy a nicer place, or buy another duplex.
Yeah.
Um, is there, so jumping from that first investment property to the next to buying another investment property, is there anything people should know when they're looking at financing that second investment property?
Yeah, and that's the big key too, is the more a lot of people get stuck after that first investment property. Like, all right, I got one house, now I got another, and then they get stuck because they don't know how to advance to that third investment property. And at that point, it's now you've got, where am I going to get my down payment? I already tapped into my primary residence on the last investment property. So where is that coming from? And there's tools for that. And that's where, you know, maybe you bought that first investment property was $250,000, and you had to put 25% down on it. Where am I going to come up with another 50 grand? So there's some ways that you can tap into equity again. There's ways to do that if it's there. But let's just say you do come up with that down payment money. It gets a little trickier now because you have to have reserves as well. So the more properties you own, the more reserves you need in the bank. They're going to scrutinize, and normal lending standards, they're going to scrutinize your income a little bit. Like, okay, has he, how much, there's this, you got your regular house payment, you got any other loans you have, you got your mortgage payment, you've got this rent coming in, you've got your job, how's the cash flow looking? Are you going to qualify for this third house? Well, now we're counting income from the rental property you have. So depending on how that looks, there's that. But the more houses you get, the harder it becomes to qualify for traditional financing. And so there is what we call like non-traditional type loans that you can get to help grow your rental portfolio. And that's what I think is also really underutilized by most people, because most loan officers, they don't know how to sell it. They don't know the ins and outs of the products and who might qualify for it. So, if I took a client right now that had 5 investment properties and all of them had loans on them, and let's just say each one of those investment properties had a $2,000 payment, I would need to have roughly $60,000 in the bank in reserves. So that's on top of their down payment and things like that, if I did traditional financing for them. But if I did some non-traditional financing types, one, I can get away with slightly less down payment, and we'll talk about what those loan types are. And two, I don't need all those reserves anymore. I just need maybe $8,000 in reserves or $10,000 in reserves. And those can be like a retirement account. I can count for reserves. And so some of you might be getting lost when I'm talking about this, but for example, there are loans that you can qualify for, Jacob, that are just strictly, and this, but strictly based off of how much rent a property is going to bring in, where I don't have to look at anything else. I don't have to look at the other 3 rental properties you own. I don't have to look at the payment on your primary residence. I don't have to look at your car payments, credit card payments, anything like that. I strictly can qualify someone based off of how much rent the house they're buying brings in, which I think is amazing, right? Because
What do you call those loans?
we call them DSCR loans, debt service coverage ratio. So basically, you've got a payment of $2,000, but you have rent coming in of $2,001. You qualify for the loan, and in some cases, you actually qualify with negative rents. So let's just say your rents are 1,500, but your payment's 2,000. We can still qualify someone to buy a house with that in that case because they know it's a appreciating property. You're still, it's a vehicle that's bringing you wealth by owning it. Rents are going to eventually go up. So it's pretty slick. There's a lot of tools out there, and I never sold the products until this year. Like I started, we've done 5 or 6 of them in the last 4 or 5 months, and it's really helped investors that I work with get the next house because they were stuck getting the next house.
Interest rates are a little bit higher on DSCR loans.
Little bit sometimes actually. So sometimes there's a few tricks to it, and they're definitely for investors only, but or people who are going to be long, but they can be a little bit higher unless like you take a prepayment penalty. So if we throw a 3-year prepayment penalty on it, so these loans are meant to buy and hold. It's not meant to buy and flip because they have prepayment penalties to get you into the best pricing. But I did one, a cash, someone owned an investment property free and clear. They needed they ended up getting $150,000, and we got them at like 7.5%, 7.375%. And we put a 2-year prepayment penalty on it. So she can't refinance with me for 2 years, but it was still 7.375. She was using it to like buy a bar, the building that her bar was in. It was just a pretty cool deal. And they're usually adjustable rate mortgages too. So you guys get, the typical buyer gets scared when they hear adjustable rate mortgages. We put them usually on like a 5-year adjustable rate mortgage. So, depending on what the market does in that 5 years, we're kind of at the top of interest rates right now. It's May 2024. Interest rates are in the low 7s for, good buyers. So, yeah, if we get to a position 5 years from now and you're still in that loan, you just simply refinance it again in another DSCR loan, or you're selling it at that point to go buy 2 more. Do you ever like see people, Jacob, where, I've seen positions where someone wanted to grow their investment portfolio and they would sell 1 house to buy 2 because they could take so much equity out of it by doing that. And now you have enough money to go buy 2 houses because, you just get a loan on both of them. Or I had one guy who did that, and he sold 1 single family residence to turn around and buy a 4-plex. And that 4-plex was just raking in the rents. It was pretty sweet.
Yeah, I think like a lot of people have these pretty nice homes, and they have all this equity sitting there, just not doing anything. Um, my investment mind says they should sell that nice property and reinvest it into multifamily properties. Be a heck of a lot better usage of all that equity than it just sitting in a house that's not doing anything. But it's also nice to have a nice home. So, but yeah, I like, I've been working with an investor client that has a property he's looking to sell, and then do a 1031 exchange into multiple, into a larger complex. But it's just trying to put that deal together is challenging. You got to have a good investment
Like,
property to buy, which it seems like, at least around here, it's hard to find a large investment property that cash flows.
uh-huh.
At least in the Pullman Moscow area, it seems like the cap rates are pretty low. And so, um, yeah, so that's, I don't know if I answered your question, but
Yeah. So how do you identify, how would you identify a good investment property for someone then?
I would say, I mean, typically cap rate's kind of how you look at it. You look at the gross rents minus expenses divided by the purchase price, and that's how you get the cap rate. In, I mean, typically you want your cap rate, say like a cap rate historically in Pullman, like a 6 cap rate was good, but when interest rates are 7, um, it doesn't nothing really
Anything.
pencils out right now. You kind of want to be over your interest rate for a cap rate, unless you're convinced that interest rate's going to drop. You can refinance that property, which maybe that will happen, but most investors aren't going to buy something if the cap rate isn't good enough to buy right now.
Yeah. Because like Pullman, Moscow for investment properties, typically pretty good. Like good place to be an investor or have investment properties for the most part.
Yeah, it is. If you can get a property that where the seller is selling it at low enough price that you can buy it and rents can cover, all your expenses and mortgage payment. But right now, just there's not much on the market that kind of fits that bill, at least in Pullman, Moscow. Um, so if someone wants to sell a property that makes sense for investor clients, that would be awesome to see. But you know, in college towns, sellers typically get pretty high rents, so they're not super motivated to sell.
Yeah. Yeah, that's kind of notice that. And then heck, a lot of the times there's nobody in the house for a couple months out of the year because the kids are going home. They rent the house.
So you lease it for 12 months, and it's only used for like 9 or 10.
Yeah,
That's a pretty good
less
deal.
wear and tear. Yeah, that's kind of cool. No, that's crazy. Yeah, I've been seeing a lot of younger people though, and I love seeing it. Like when they're inquiring about their first house, investing's on their mind. They're already thinking about the next one, and I think that's the best mentality for someone who wants to do that. Me personally, I don't want to be a landlord at this point in my life, but I should be. I mean, it's the only
What?
asset
So
that's
why don't you want to be a landlord?
you know, I don't know.
So okay,
I
so
really don't.
maybe you don't have to be the landlord, but don't wouldn't you want to own an investment property if you could have someone else manage it?
Yeah, there is that's crossed my mind. And so and I recently faced that dilemma because I sold a house that had an interest rate that was 2.625%, and I'm never going to get that interest rate back ever. Like I'm never going to get it back. And that house would have cash flowed extremely well. I mean, I bought it in a when the prices were low, in 2019 in a brand new community, and the prices just kept going up after I bought it, and rents would have far outweighed my mortgage payment because that rate was so low. And I just I don't know. I didn't
Is
want to.
it is it too much of a risk for you as a buyer? Is it too much of a risk, or is it just out of your comfort zone?
For me, it came down to I wanted to take advantage of every single dollar of equity I gained in that house when I sold it. You hear that clapping? Anyway, I wanted to take advantage of all the equity I had to help put towards. I was building a house, so I kind of needed to for the way it was going to shake out for me. I needed that money now, and I for like debt ratio purposes and stuff like that because it was going to take the house. I wasn't going to be able to count rents on my departing residence while I was having my home built. So there was some funky things going on there. In a perfect world, I would have loved to have been able to hold that until my new house was done and then convert it though. I would have highly considered it because it would have rented well.
Yeah, yeah.
And I had, in worst part is I'd actually used that equity to buy a different piece of land. So I didn't have equity to go turn around and put into my construction loan because I have this other piece of dirt here. So, however, though, buying real estate, I've bought 3 pieces of real estate in the last 6 years, and they all have appreciated. Like it's all been better than any other cash investment I had for, call it your 401k or your any investments and annuities you have, because there was that period during COVID where all that lost money. I don't know what that clapping is. So I didn't know we had a crowd.
So what I guess to kind of end this video,
Yeah.
let's talk about, I guess, let's wrap it up with maybe. I got nothing. We might have to cut this part out. What should we talk about? We've talked about a lot.
Yeah.
What should we talk about the in the video?
So let's end with this. So uh Jacob T. Davis, I'm calling you, and I I want to I want to buy my first house, and I know I only want to stay in it for a couple years so that I can go buy my next house. Uh, I'm handy. I can fix things myself, right? What are we looking for? How do we know what the perfect house is?
Well, I I look at homes a little differently. I think than most buyers. First of all, I think if the home has a good foundation, I think you want to buy a home that's structurally sound. If a home's like kind of ugly, usually there's an opportunity there.
Just
Um,
cosmetic.
like flooring is beat up, paint's beat up. Maybe it needs a new roof. I mean, I know people don't want to put a new roof on a house, but I mean, usually where there's problems, there's an opportunity, and so paint's super easy. If the color on a house is ugly, I mean, that's like there's just I look at it as money. It's like I could if I didn't know how to paint a house, I could show a person how to rent a sprayer and paint that house in a couple days.
Mhm.
It's going to be a couple long days. But I just rented. I just let one of my buddies borrow Heather's husband. They just painted their house. Uh, Salter.
I heard about that. The neighbors were complaining, but
Yeah.
yeah, yeah, I heard her neighbors were complaining about that.
So,
But
so anyways, they painted their house in a couple days, and it's like when a house is ugly, when the roof looks like it's bad. I mean, those are the kind of properties in my mind that are like gorgeous because there's so much opportunity. When I am showing a house and it's totally dialed in, it, you know, I know that like when I take a buyer through these cream puff homes, they're just going to get so excited, and it's like my investment mind says like you're going to get um, taken because somebody did the work, and it's like I just want to, it's like the opportunity exists in these ugly houses that people can go and fix them up and then build 100,000 equity like overnight. It just blows my mind that people can't see the opportunity.
yeah, so you're saying find someone with good bones that could use a little lipstick
Yeah. So
and
yeah. So maybe we should redo that. So ask your question again because I'm going to cut that whole. I kind of went on a tangent.
oh,
Ask your
cool.
question
Okay.
again.
All right. All right. So to wrap this up, Jacob, then I'm a first time buyer. I know I want to buy a house. but I know I want to buy another one in a couple of years. I want to become an investor. What kind of house are you going to show me? What are we looking for? What's the investment opportunity?
So first of all, I would ask you like how much work you're willing to put in. Because if you're looking for an opportunity, if you're looking to build sweat equity, I think location is huge. It's all about location. So if you can find the smallest or the ugliest home in the best location, generally that's going to be how you're going to build the most equity fastest, I would say. You want something that's structurally sound. Hopefully, it's got a decent roof on it. If it's just cosmetic where it needs new paint, new flooring, maybe some new fixtures, then I mean that's usually a home run. So,
Wow.
um, but yeah, I think location's huge, and then so you want to look for a great neighborhood. Uh, Ugliest house in a great neighborhood. That's usually a
That's
pretty winning formula.
Yeah, that makes sense. No, that really makes sense though. So, man, I like it, and I think that helps people understand what makes a good investment property. And I like how you said, how hard are you willing? How much work are you willing to do? That's a big because if you're hiring everything out, that's cutting into your profit, right? But the more you can do on your own, or kind of GC yourselves, I mean, you're gonna have to hire some stuff out, but
Yeah, I would say, yeah, don't hire contractors unless you absolutely have to. Because, I mean, if you're looking to build equity and grow an investment portfolio, you need to learn skills. I think that skills are the best way to I think grow your wealth. Like the more you work on these properties, you learn how to paint, you learn how to do flooring, framing, roofing, maybe. Then you can just build your equity.
nice. Yeah, good. Oh, well, all right. Well, I'm looking forward to hearing someone that watched this who's ready to get the process started so they can start investing and whatnot. So, we covered a lot of good stuff. And then someone could always just call you, right? They watch this, they got ideas, they want things they want to do. They can call Jacob. You guys call me if you want to figure out the money side of things. We're we do a lot of. I think we both work with a lot of investors, and you've invested a lot in yourself. I've bought and sold stuff a lot. I haven't been a landlord, but um, you know, give us a shout. Woo, woo,
So,
woo, woo.
how do they find you? I mean, I can't see, like, I can't figure it out. It's like, is it behind you? Is it on your background? Is that how people get a hold of you?
That I needed to put something back there. Yeah, that's my website, jelending.com. Or 509-701-0558. My phone number. Pretty easy, yeah. Call, text, email, you name it. Just look up Jared Evenson, you'll find me.
Noise. And you can always find me by just Googling Jacob T. Davis or, yeah, woodbridgereal.com. That's our Woodbridge website. So, anyways, Jared, thanks for joining on another Cougar Real Estate podcast.
Yeah, a brand new name. I love it. It sounds good.
Does it just goes. It just works.
Flows. All right.
All right, man.
All right, brother.
All right, next time, talk to you later.
Good to see you.
Woo-woo.